Okay, great. Good morning. I'd like to thank Holly, Harry, the full team at Coaltrans for putting on another outstanding conference. This has been a great week here in Barcelona. I'm looking forward to a great panel now to discuss the metallurgical coal price outlook. I'll start with a little bit about our company, Corsa Coal. We are a metallurgical coal producer headquartered in Pittsburgh, Pennsylvania. We produce and sell this year just under 2 million tons of metallurgical coal. Most of that is on the low-vol side. We sell our coal all over the world to customers in the United States, Korea, Middle East, Europe, and South America. The cover of the presentation here is a photo of our grand opening ceremony for the opening of our Acosta Deep Mine, which we opened in June. It was really a day of celebration for our company, opening up a new underground mine, which was a day of celebration that was sorely needed after 2 years of 2015 and 2016 of pain and suffering in the industry. We opened this just southeast of Pittsburgh, Pennsylvania. Very much a political event in our country. President Trump did a 2-minute video for us commemorating the grand opening, and also our Democratic governor of the state of Pennsylvania was also in attendance. It was a bipartisan event, a lot of fun for our community and for our employees, and a great day for our company at Corsa Coal. So a little bit about us, page 1. We built this company through acquisitions. 3 acquisitions over the last 5 years built the company. The most recent acquisition was the acquisition of a company called PBS Coals from the Russian steel producer Severstal, which we closed that deal in August of 2014. We're publicly traded on the Toronto Stock Exchange, and we're very much in growth mode. We've more than doubled our sales in the last year, and we've more than tripled revenue. And we've opened up 1 new mine. We plan to open up at least 1 new mine next year and possibly another one late next year. This year we'll sell about 1.7 million tons of met coal. Most of that is on the low-vol side, but we also market mid-vol and high-vol products all over the world. Next year we expect to sell at least 2 million tons and double our own internal production. Our assets are mainly located in southwestern Pennsylvania. We ship out of the Port of Baltimore predominantly, but we also ship out of DTA, Pier 6, Pier 9, down in Norfolk and Hampton Roads, Virginia. We're a producer and a trader, so we've got 3 ways that we make money at our company: selling tons that we ourselves produce, selling coal that we buy on a raw basis locally, wash, store, blend, and load, ship that to our customers, then also what we call our sales and trading platform, where we buy coal on a finished basis and sell that to our customers as well. A little bit more about our sales and trading platform here on page 2. As I mentioned earlier, we sell our coal all over the world. Some of the blue chip customers, some of which are represented today in this room. We sell full vessels, Panamaxes, Handymax, Supermaxes off the U.S. East Coast. Since launching our sales and trading platform, we've had 6 consecutive quarters of at least 20% sequential quarter-on-quarter growth, which we're very proud of. We've got a great balance sheet and great set of financial partners at our company, which we're also very proud of. And then finally, to end the Corsa commercial, a little bit on our coal qualities here. As I mentioned earlier, we market both low, medium, and high-vol metallurgical coals, typically in the ash range of around 8%, sulfur range near 1, volatiles anywhere from 19 to 22 on the low-vol side, 24 to 28 on the mid-vol side, and 31 to 34 on the high-vol side. So I was asked to talk about the forecast for metallurgical coal demand and where prices are headed. As you can see on page 4, it has been a wild and tumultuous 10 years for metallurgical coal prices, and that might be understating it. In fact, met coal was the most volatile commodity in 2016. But we've had now 4 price spikes in the last 4 years, which suggests that this is a very fragile supply chain. You've got extremely inelastic demand for met coal, and the combination of those 2 things leads to extreme volatility, which is exactly what we've seen in the last couple of years. If you go back and analyze the last 10 years, in 2008, the big price surge was predominantly driven by wet weather in Australia, as well as $1,000 steel prices globally. So it was a combination of both supply shock as well as demand. Global financial crisis hit in late 2008. Prices cratered at that point due to lack of demand. And then you had in late 2010 a big Australian rain event that caused prices to skyrocket again. So that was very much a supply-driven event. The next 5 years was a very miserable time in the metallurgical coal sector. You had a lot of Australian production that came online, approximately 50 million tons a year of exports that came online. Those projects were commissioned on the strength of that 2011 price spike. It takes a long time to build, capitalize, get the equipment, get the people, and launch a new mine. So a lot of the production decisions that were made in 2011 and 2012, those tons didn't actually come into the market until 2015 and 2016, which is when prices bottomed. Those tons came into a market that had no need for tons, because in 2014 through the first half of 2016, the steel market was extremely weak. Steel production growth was negative in those years, so you had an oversupply situation that created the longest and deepest downturn in the met coal industry in 60 years. In the United States alone, there were 50 bankruptcies in the coal space, both thermal and met, and it was just a miserable time globally for met coal producers. Now, what that did is that led to a dramatic undercapitalization of mining companies, led to a lack of reserve replacement, lack of investment in people and equipment, which then created the stage for the inability to respond and bring on new production when prices went up. That's exactly what happened late last year. As the Chinese restricted workday policies, you had a lot of tons came out of the Chinese market. I'm going to argue in this presentation that China is the swing supplier and sets the price of met coal. And when that happened and those tons came out of the market, the rest of the world was unable to respond with more production to meet that demand for higher prices. And what you saw was a tripling of met coal prices. The last year, we've had a tremendous amount of volatility, which really reflects a market that's in deficit, and I think will remain in deficit for the next year, which we'll get to. I like to try to put some data points on this page when I present it, so that people don't lose track of where we've been. Believe it or not, the 10-year average price for met coal price is $185 a metric ton. The forward curve for next year is $154, which is in backwardation, suggests a drop of around $30 a ton. And the forward curve for 2019 suggests prices in the low 140s. I would point out that still reflects a market in deficit, supply deficit, because those prices are above the marginal cost curve for the industry. Speaking of the marginal cost curve on page 5, this is data from Wood Mackenzie, but I think one of the best indicators for the floor, and let me emphasize, the floor for seaborne prices is the 90th percentile of the marginal cost curve. So this is the point on the cost curve where 90% of producers are profitable on a cash basis, 10% are unprofitable. And it's my view that, and it's many people's view, that for a given level of demand, this relationship holds true. The data bears that out from 2000 to 2014. Then you had a breach in this relationship. The blue line underneath the volatile met coal price line is the 90th percentile of the cost curve on this graph. And you can see it did in fact serve as a floor from 2000 to 2014 for pricing. In 2014, that relationship was breached, in large part because you had that Australian new supply coming into a market that did not need it. So you had a situation where there was no incentive to produce whatsoever. That did not stop a lot of coal producers from producing, but there was no price incentive to produce, which is what led to that dramatic drop in pricing. This is a graphical representation of a quality-adjusted cost curve, and let me emphasize quality-adjusted, that Wood Mackenzie produces. This is an incomplete picture of cost, because what this represents is operating cost per ton. What this doesn't include is capital expenditures and debt service. And especially when you're talking about a multi-billion-dollar Australian project, there's a lot of cost below the operating expenditure line that have to be factored into a producer's income statement and cash flow statement. That's not represented on this cost curve. But what this curve represents is a 90th percentile. If you look at the fourth quartile and you say, okay, where's that last 10% fall on this cost curve, it would suggest a marginal cost curve of around $130 a ton. So I think in a steady state environment, in theory, that should serve as a floor for pricing. But remember, this doesn't include CapEx, it doesn't include debt service, so it's an incomplete picture. Now, if you flip the page and look at page 7, I think a better way to think about costs is what is the incentive price that's needed for a new producer to bring on tonnage. And that incentive price would look at debt service, it would look at CapEx, it would look at return on investment. What this graph represents, this is also by Wood Mac, is a 15% return on invested capital for a project. And if you contrast this to the previous page, it would suggest that you need an additional $20 to $30 a ton on top of that marginal cost to actually make money, which is why we're all here. So that would suggest something closer to $150 to $160 price for a market clearing price in a steady state environment for a coal producer. And to put that in context, today prices FOB Australia are around the 180 mark. FOB East Coast U.S., it's a little bit less than that. 2 years ago, it was down in the double digits, below $100 a ton. On page 8, we look at just a one-year history of prices. And I like to speak to this page because it really emphasizes the actions that have taken place in China over the past year and a half. A lot of people talk about the United States being the marginal supplier on the seaborne market. I would argue strongly that China is that marginal supplier and that China sets the price of metallurgical coal globally. Their import needs, their domestic production, their domestic price are the three main ingredients into the seaborne price. The last 15 months or so of pricing that's shown here on page 8, as I mentioned earlier, when China restricted their workday policy almost 2 years ago, that set in motion a reduction in supply in country. The industry globally was in a vulnerable state, unable to increase production to offset those cuts, and the result was a tripling of price that we saw peak in late 2016. A period of destocking occurred over the next few months. Prices went down. It looked like we might be headed back into the state of misery that we experienced in 2014 and 2015. However, a cyclone hit Australia, Cyclone Debbie, and essentially knocked them out of exporting for the full month of April of 2017. That caused prices to go back to $300 a ton for a short period of time before correcting again. And what you've seen over the last few months is a gradual increase in prices reflective of a market in supply deficit, but also reflective of a very, very healthy steel industry, which we'll hear about in a moment, which caused a lot of demand, raw material input demand for iron ore, Metcoal, which then caused the price to get back to $200 a ton before another period of destocking occurred along with the Chinese holidays that have let us down 10% or so since then. So in terms of some of the Chinese policy initiatives, I think it's critically important to understand what's going on in China and why they are doing what they're doing. A lot of people say, okay, they restricted work days, they're doing environmental safety checks, but why are they doing that, I think, is the question that needs to be asked. And I think you also have to convince yourself that China sets the price of coking coal. They produce about half the world's coking coal, they produce about half the world's steel. Their policies, in my estimation, set the price. China has a national security interest and an economic interest in having a healthy coal and steel industry. These are essential parts of achieving their social and stability objectives, and I don't think they're going to stop doing that. Last year, what they did is restricted the work days, essentially going from working 6.5 days a week to working 5.5 days a week, which took out about 40 million tons of production of met coal in China. Big impact. That's over 10% of the seaborne annual traded met coal tonnage. This year, they've taken a different approach. They haven't restricted work days, but what they've done is undertaken a very aggressive consolidation strategy. They want to have fewer coal producers in the country so that they can control those producers better and have a top-down supply discipline, and that's their objective. They've done that through safety checks, environmental regulations, and capacity reductions for the smaller producers. And I think they'll continue to do that until they can have that top-down kind of command and control approach to regulating their industry. China's openly setting prices on the thermal side. They've got public announcements on thermal band pricing, a ceiling and a floor, and I think they're doing the same thing indirectly on the met coal side. The other thing I mentioned earlier, all the bankruptcies that occurred in the U.S. coal industry in 2015 and 2016. The restructuring of the U.S. coal industry was a financial and legal restructuring, the bankruptcy process. Restructuring in China looks very different, but I would argue it's nonetheless underway. China is not a low-cost producer of met coal at all. They're a high-cost producer. and they did not get the benefit of bankruptcy erasing the debt that's on the balance sheets of the coal producers. If you look at two of the larger coal producers in China, Shanxi Coking Coal Group and Datong, Shanxi Coking Coal Group has over a 10 times debt to EBITDA ratio. Datong also has a very high debt to EBITDA ratio. Very expensive principal amortization and interest expense for these two producers that adds to their debt load. They need high prices, and China needs them to have high prices for them to service this debt and be healthy as an industry. Mining costs in China are very high. A lot of deep mines, a lot of methane gas. Logistics costs are very high as well. So discipline is being introduced. Restructuring is taking place in China. We don't see that trend ending at all. We see it remaining the same, if not accelerating, which is going to continue to put pressure on Chinese met coal production. A couple of other anecdotes as it relates to China, because I think it's so critically important to how that seaborne price is set. I found the June 26th announcement by four of China's largest met coal producers to be extremely relevant and an extremely strong signal of where their break-even price is. So let me put some words around that a little bit. Back in June, late June, you had the low point of pricing for the year for met coal in 2017. Prices got down to about $140 FOB vessel in Australia. And at that time, on June 26th, four of China's largest producers stepped forward, raised their hand, and said, we are going to voluntarily cut production by 10%, signaling about a 13 to 14 million ton removal of tonnage from the market. In my opinion, that was relevant because it was a direct signal of where their pain point was. And I think it was not coincidental that that served as the low point for prices for the year. And you can see in the bottom left corner the prices, a 3-month price graph. That, in fact, was the low point when the Chinese producers raised their hand and took that action. One other, I think, relevant thing, last year, late in November of last year, Shanxi Coking Coal Group came out and said that their break-even cost per ton, or they announced the break-even cost per ton, which when you do the math on preparation yield, logistics to the port, freight to Australia, you come up with a break-even price FOB vessel in Australia of about $146 a ton. So that's another data point that points to that 140 to 150 range as you try to build that case for that floor for pricing. A little bit on the supply-demand fundamentals of the seaborne market. I've highlighted a few. What this is the leading importing countries and the leading exporting countries of metallurgical coal globally. You can see some of the trends on this page. I've also highlighted a few things that I'd like to speak to on this page. As I mentioned earlier, what really put us in the low-price environment of 2015 and 2016 was the 50 million tons of export growth that occurred in Australia. Okay, and as we look at demand growth for met coal over the next few years, you can see from 2016 to 2019, demand is increasing by 37 million tons for imported coal. The question then becomes, who is going to fill that supply gap? There's a vacuum, there's a lack of new projects that are on the drawing board in Australia because of the long lead time it takes to start those projects. So I don't think Australia is going to be the producer that fills that gap. The question then becomes, who is it? Who fills that demand need? I think the United States has grown production, grown exports, but has been left in such a decimated, weakened state by 2014 through 2016 that they're not going to return back to the mid-60, 64, 65 million tons a year of export. So I don't see the United States stepping forward as that leader. Canada, Russia, we see limited growth from those two countries on the export side of met coal. Mongolia, we see them plateauing, a lot of high cost in Mongolia, logistical issues. Mozambique has been historically challenged, a lot of high-profile challenges in Mozambique. So the question really becomes, who is the country that's going to fill this demand gap? I don't have a good answer. That would suggest to me that we're going to continue to see a tight market for the foreseeable future. I was asked to speak to the next 12 months, expectations for pricing for the next 12 months. What I've done here is shown the last 12 months, or the last 15 months on the left, and then to the right of the dotted line, you can see the forward curve, the CME forward curve for met coal prices. I can assure you of one thing: this is not the path that prices will take. This is far too smooth. There's not enough volatility at all. but this is what the forward curve does look like. I continue to feel that the market is in deficit. We've got a very fragile supply chain. That contrasted against a very inelastic demand from the steel producers for met coal suggests that the volatility will continue. But we are in backwardation. I do think prices will revert to that 145, 150 range over the next several quarters. What I'm hopeful to see is a balanced industry where the steel companies and the coal companies are both making money. I think that's the point that we're all seeking. We'll see what happens. On page 14, and I think this overlays well against the last page. You can see the forward curve gets down to around the 140 range over the next couple of years. I think that is well supported by anecdotal evidence. Some of the data points that we've seen in the market over the last year, the actions in China, the June 26th voluntary production limitation that the four major producers did, Shanxi coking coal's break-even cost, the thermal coal price band. If you extrapolate that into a met coal price, you get around a 145 to 150 implied price for met coal. The marginal cost curve, the incentive cost curve, and then the 2019 forward curve, they all point to the same numbers, and that's 140 to 150 per metric ton FOB vessel on the east coast of Australia, east coast of the U.S. So we feel like there's a compelling case that that's the right floor for pricing. As long as the market is in supply deficit, which we believe it is, we see volatility above that level in the quarters ahead. And then finally, in closing, I was asked to speak to what are some of the leading indicators that we look at Corsa Coal for met coal prices. I listed several things here. Number one is what's happening in China. What do their imports look like? What do their policy initiatives look like? What does their domestic pricing look like? Is the arbitrage open when you compare the domestic price of met coal in China versus the seaborne price? If that domestic price is higher, and they're going to be importing more, that's going to put pressure on the seaborne market, typically leads to a restocking phase, which then leads to higher seaborne prices. So we'll continue to watch that. I think that's the number one leading indicator. Dry bulk freight rates have been coming up here recently. That's very relevant in terms of certainly our customer mix. A lot of our customers are sensitive to transportation costs. That's becoming increasingly important here in the recent months. But we'll continue to watch that. Global steel prices and coke prices. We think the U.S. is going to be short coke in 2018. We see a lot of catalysts that could support global steel prices in 2018. That would be very healthy for the raw material demand side of things, which should support prices. Inventory levels at the Chinese mills, currency moves. We've seen a little bit of a weakening in the U.S. dollar over the last couple of months. That helps U.S. producers. But over the last few years, you've seen a very weak Australian and Canadian dollar, which has certainly helped their exports as compared to the U.S. Hedging the forward curve. Hedging is starting to become a reality slowly but surely. It's not there yet, but I think at some point in the next 12 months, we'll start to see more of that to catch up with other commodity industries like oil and gas and some of the metals. And then finally, expect to see a lot of volatility. Okay, so I'll close with just a photo of our sales team here. I think he walked in there in the back. There's Fred Cushmore leads Corsa's sales and trading platform. That's him in a buggy there about to go into a mine, dispelling the myth that he's never been to a mine. He has. And also on our sales team is Hunter Hobson, Steve Meehan, and Mike Ryder. Okay, well, I thank you for your time and attention, and I'd like to open the floor up to a couple of questions if there are any. Yes. I'm sorry, the question was about...
I'm Carlos Ferrandez from the IA. So when you show the balance import, export, import, you have like a 30 million tons increase in others. So where is this? Who is this other? Because you have India, China, EU. I think.
Yeah, I think that other is going to be Southeast Asia, countries like Vietnam, Eastern Europe. I think that's going to comprise most of the other, is those two places. Yeah. Yes.
You didn't include Mozambique in your supplier list, but you mentioned them briefly, but you implied that you didn't think much more would happen from Mozambique. Why is that?
They would be in the other part of the export list there. I do think the tonnage will increase in Mozambique. They are extraordinarily well positioned near India, which is, of course, the leading import growth story on the Metcoal side. Mozambique's had a lot of challenges, as we all know, over the last 5 years, increasing their supply, but it looks like things are improving there. So I do think Mozambique is going to be a major player. Okay, well, guys, thank you very much for your time and attention. Well, good. Well, I'd now like to shift into the panel discussion part. So I'd like to invite our three steel industry executives up to the stage, and we'll start in on the section, the forecasting metallurgical coal demand from the steel industry. I am really excited for this upcoming segment. I think we are joined by three of the leading executives of some of the world's largest steel companies, Margriet from Tata Steel, Liem Hazoume from ArcelorMittal, and Yevgeny Shmakov from Metinvest. These are three leaders in the industry. They control the raw material sourcing for much of Europe. And if you're looking for a fantastic group of steel executives and a fantastic discussion, you've come to the right place. So I look forward to this discussion. Well, good. Today we're going to talk with Margriet, Yevgeny, and Liem about three main topics. Number one is what growth can we expect from the steel industry over the next 4 quarters? Number two, what are the downside risks for European steel production? And then number three, to what extent is global capacity hampering steel production? We'll also talk about their views on coal and raw material sourcing, but especially coal, since this is Coaltrans. And possibly get some questions from the audience, as well as some other topics if we have time. So let me first introduce our first guest panelist, Margriet Niep. Margriet is the head of raw material procurement for Tata Steel. She has leadership of both metallurgical coal and blast furnace coke procurement. Prior to joining Tata Steel, Margriet worked for Corsa Steel, leading their product market development and product innovation for steel strip products. Margriet has a PhD in coal chemistry from Delft University of Technology and a Master of Science degree in geology from Leiden University. She is a true expert on both coal and steel. Ladies and gentlemen, please welcome Margriet Niep.
Good morning, everybody. A pleasure to give you a short introduction of my company, Tata Steel, before we go into the discussion on the 3 questions which are under our focus today. Tata Steel, very big company, as you know. It is, of course, coal is very important, like iron ore and many other raw materials we use as input materials. But for us, the bread and butter is in selling steel products. Which add a lot of value. We are a big group, as you know. We have our footprint in Europe, but also in India. Annual crude steel production of more than 28 million tons of steel, and actually this year is the first year that we are producing more steel in India as compared to Europe. It has to do with 2 factors. First of all, We sold off our long products division last year, and which is continuing now as British Steel. And we have commissioned the first phase of our new greenfield site in Kalinganagar in the Orissa province, which will produce about 3 million tons of steel, and the next phase to follow later with an additional 3 million tons of steel. Many employees, as you can see, we are present basically everywhere in the market, and we are a member of the Tata Sons Group, which has a total turnover about $100 billion. So you can see that Tata Steel really takes a big portion out of this. Here you can see that indeed our footprint is very global. When you look at our upstream production facilities, which in this context I think is worth mentioning. In Asia, the two plants in India, Jamshedpur, now producing 11 million tons of steel, and the one I just mentioned, Kalinganagar, 3 million tons of steel, with the next phase of 3 million tons of steel to follow in Orissa, East India. We have two steel sites in Southeastern Asia, in Thailand and in Singapore, and then of course in Europe over here we have two integrated steel mills, one in IJmuiden, where our procurement team is located as well, and in Port Talbot in Wales in the UK. Speaking about our markets, well, you see that we provide our steel, we supply our steel into many different markets. It's mainly flat steel products which we do, which is our bread and butter. Very important strategic market segments for us are automotive. We sell a lot of steel into automotive, and we really have a diversification, a differentiation policy there to really create value-add products. That's why we have a huge R&D facility to support us in this endeavor. But other than automotive, packaging is very much worthwhile to mention, and we're also increasingly more active in the energy and power segment, especially the windmills sector is very lucrative for us. In terms of coal buy, I think it would be worthwhile to mention here what, let's say, the overall numbers are. Bottom line, for both India and for Europe, we buy about 15 million tons of steel, and here you see the breakdown between coking coal and PCI coal, both over the different geographies. So that is the footprint as it is per today, and that will continue for a while, although you probably will all be aware that very recently an MOU has been signed between Tata Steel and the ThyssenKrupp in order to explore the opportunity to create a joint venture company. This process actually is kicking off as we speak. We are just starting now the due diligence procedure, which will take a couple of months. And well, if things are as planned, the whole process should be finished by the end of next year, and then we will see where we stand. But the idea would be, as you can see here on this slide, is that a new company would be created, which would be producing around 22 million tons of steel, so it would be the second largest in Europe. So that would be the idea going forward, and obviously that will bring some changes to the whole scene. So for now, I would like to leave it with that as far as the introduction is concerned, and I think later on we will kick in the discussion on the markets and so forth. Okay?
Thank you. Thank you, Margriet. I'd like to now introduce our next speaker, Yevgeny Shmakov from Metinvest. Yevgeny is the Director of Marketing and Purchasing Strategy Department for Metinvest Holding, vertically integrated steel and mining company in Ukraine. He's responsible for marketing and purchasing of metallurgical coal, iron ore, ferroalloys, and other materials for carbon steel production. Prior to joining Metinvest, Yevgeny held several positions at Severstal, the Russian vertically integrated steel and mining company, leading their sales of Metcoal and iron ore for export customers. Ladies and gentlemen, please welcome Yevgeny Shmakov.
Thank you, George. So how it will? Okay. Metinvest is just will give a brief introduction to our company, and Second part of my presentation will be about Ukrainian steel and coal industry. So what we see, key developments, and basically we'll try to give you some insights on what will be next year. Metinvest is a vertically integrated steel company. So we have mining and steel side of the business. We have 85,000 employees working for our company, mostly in Ukraine. Key assets, steel plants are located in Ukraine. So we have 12 million ton crude steel production in 2016. We produced 4.8 million tons of blast furnace coke at our coke plants, also in Ukraine. And we have more than 38 million tons of iron ore also produced in Ukraine. So we have two mines. One mine located in Ukraine, even though in the conflict territory, so we do not control this business anymore. But United Coal, this is our primary business unit, which is producing metallurgical coal, located in US, in Tennessee. So, and basically they produce 2.5 million tons of Metcoal, which we supply 100% to our steel plants in Ukraine. This is a picture of our largest coke plant called Avdiivka. So they produce right now 300,000 tons of blast furnace coke per month. So basically they are trending right now to 3.6, 3.7 million tons per year. They produce 50% of our met coke at coke plants in Ukraine. In terms of overall steel industry in Ukraine, so production, which we see at the moment for 9 months, it's 14.4 million tons of crude steel. So I think we will make, as a country, approximately 21 million tons of crude steel by end of the year. Metinvest is producing more than 50% of the tonnage, and we will keep our share in the market. And we'll try to produce even more. And how, I will tell you in the next slides. Location of our assets: iron ore mines located in the central part of Ukraine, and steel mills are located in the southeastern part of Ukraine. All coal which we buy from overseas suppliers is coming to Odessa, and then we are distributing to the coke plants in Ukraine. This is a slide about basically impact of the conflict in the east of Ukraine to the steel industry. So we, as I told you earlier, so we lost control of the assets in the conflict territory. It happened in February. These assets were seized, and we do not control them anymore. So it was Yenakivo, Khartsysk pipe mill, and coal mine. Some other people like Industrial Union and Donbass and Donetstal also lost, and basically overall, when you look at the capacities, 7 million tons of steel production lost. So basically they do not produce anything right now, and these capacities are not in a balance anymore. So, but what we do as a company, we are trying to maximize production at our existing assets, and we are pretty successful at doing this. So we increased production in Mariupol, we increased production at Zaporozhstal, and basically we will try to get to 2016 numbers with a smaller number of assets. Metcoal production, you see on the bottom table, basically 6 coke plants in total were lost in that during the conflict. They produced 7.5 million tons of coke. Right now, they do not produce anything, zero. So, and as a result of this situation, we have a disbalance. On the steel side, we will go to 2016, 2015 numbers, but on the coke side, we are coke short. So basically, existing facilities in Ukraine, they will not be able to make up the shortage. So basically, we are trying to buy coke from merchant suppliers to cover that shortage. And basically, we are trying also to get into partnership agreements with other producers and to rent or lease or to get any other agreement to use existing coke production assets in Ukraine. Here you see coal balance and steel production. So as I told, steel production 21 million ton. It's down, and it will be down this year due to the fact of lost assets in the east. But raw coal production is also down. So we see only right now 7 million tons of raw coal produced in Ukraine. It's domestic coal. So basically there is only one producer of Metcoal right now left in Ukraine. And as a result of this, 75% of our coal mix is imported coal. So basically out of 12 million tons which we need as a country, we have only 3.5 million tons approximately of domestic coal. The rest is purchased from Russia, from US, from Canada, from Australia. And you can see numbers for the first 6 months of 2017. So we got, as a country, 5.8 million tons of clean coal. Approximately 2.3 million tons came from Russia. Approximately 1.4 from its domestic production in Ukraine, and over 1 million ton came from US. So US becoming the third largest supplier of metallurgical coal to Ukrainian steel mills. Also, you see on the map traditional suppliers from Canada, Australia, and also this year we tried coal from Indonesia. So basically, total requirement in metallurgical coal will be at least 10 million tons. But what's going on, and it will have a big impact on 2018, so we are restarting with our partner, Industrial Union of Donbass, a steel mill, which was idled. It didn't work. So they produce 3.5 million tons of crude steel. As a result of this restart, additional demand on a coal basis will be approximately 1.6, 1.7 million tons per year. We will cover this demand by buying coke and coal. So, but overall, as a company, next year we will be purchasing probably 10.5 million ton of metallurgical coal per year, which is quite a significant increase from what we have today. From a quality perspective, so we got basically only one mine left in Ukraine, and they produce premium hard coking coal. The rest is purchased from other countries, mostly, and we buy all a variety of grades. So basically, from US, it's mostly high-vol A coals, some mid-vols. From Canada, it's premium low-vol coals, and Australia, we buy mostly low-vols and mid-vol coals. Basically, this situation will not change, and our coal mix will be pretty much similar, but bigger. So impact will be, for example, when we talk about US on high-vol A coals, and that's what we do at United Coal, and we are trying to maximize production at our mine by restarting our CapEx program. So when you see on this slide, since 2012, our CapEx, due to very bad times for coal industry, so CapEx was continuously going down. And this year was a very important year for us because we restarted all our CapEx programs. For United Coal, we restarted our CapEx programs for steel plants in Ukraine. And basically, we are trying to produce more at our existing assets. So overall, since Metinvest acquired United Coal in 2008, we spent close to $400 million for production developments at this company. They have 3 mines, Carter Oak, Affinity Operation, and Velmar. Carter Oak, it's a mid-vol coal, Velmar is a high-vol A, and Affinity is producing low-vol coal. So our major impact will be to develop all 3 assets to bring everything to Ukraine. So we stopped sales to US domestic market. So we had to do this, and right now we are shipping all material to our steel plants. In terms of logistics, basically we have a fleet of vessels. Every day, approximately 70 vessels are sailing somewhere in different parts of the world for Metinvest. So we are shipping steel products, we are buying raw materials, and we have a pretty significant fleet of vessels which are serving our needs. So we have Metinvest line, which is shipping steel products to Europe and to our rolling mills. We have basically time charter agreements to bring coal. And in terms of the size lots, so we try to buy Cape size lots of metallurgical coal. Then we bring this coal to Ukraine, load iron ore, and ship iron ore to China. And then vessel return either to Canada or to US and get another parcel of coal. And this life cycle is repeating itself. What we also had, we restructured our debt as a company, so we became healthier financially, so we improved our credit rating. And target is to keep it as is or become better. It requires a lot of discipline, so we are trying to avoid prepayments, we are trying to avoid letter of credits, and we are talking with our partners about better payment terms, so to help company become better and to give assurance to our suppliers that we will be able to pay for coal. And we are pretty successful in doing this. So I think this is just a brief introduction, and if you have any questions, please ask. Thank you.
Thank you, Yevgeny. And then finally, I'd like to introduce Liem Hazoume from ArcelorMittal. Liem is the General Manager of Raw Materials and the Head of Commodity Sourcing of Solid Fuels for ArcelorMittal, the world's largest steel producer. He's responsible for procurement of coking coal, PCI, anthracite, and coke on a global basis. This responsibility includes buying 26 million tons a year of raw materials for a total spend of over $2.5 billion per year. So please, ladies and gentlemen, welcome Liem Hazoume.
Thank you. So I'll try to do a small overview of ArcelorMittal for those of you who do not know. Brief presentation. So we are 200,000 employees around the world, spread in 16 different countries. I'll go more in details afterwards on the positioning in terms of steel in Europe and over the world. We are number one producer in North and South America. We are also number one producer in Europe as well as in Africa. And we have a position, I would say, in Asia in general. So in terms of steel production, we are averaging 97 million tons. And you can see here, I would say, our dear colleagues, I would say, in the steel industry. In terms of figures, so total sales around $56 billion. EBITDA last year $6.2 billion. We have steel shipments around 83. And I don't know if you know that, but we are also one of the largest mining company because we have our own mining sector where we produce around 55 million tons of iron ore. So this gives us a self-sufficiency above 40%. On coal side, we are less integrated because we have, apart from our mines in Kazakhstan, we have a mine in the US, but the total production is around 3 to 4 million tons, meaning that the rest we do buy from external producer. I will mainly just focus on Europe. So in Europe, we have more than 80,000 employees spread in 400 different sites, 16 different countries, and we do produce around 40 million tons. We are spread out, I would say, almost everywhere in Europe, where we have both our industrial and sales departments. For those of you who know, so we have a big installation in Spain, in France, so this is Dunkirk and Florange in the north. We have Fos in the south. We are also present in Belgium with a big plant, Ghent. We are in Germany, but we are also, I would say, in Bosnia, in Romania. We are also present in Ukraine, so pretty large presence, I would say, throughout Europe. We have also big R&D centers because we are focused on innovation, and we have more than 1,000 R&D people working on developing the new product for the future. We used to say that 30% of the product that exists today did not exist 4 years ago. So that tells about the importance for us of R&D and innovation. Regarding because that was one of the subjects, so just a quick overlook of on the steel demand forecast throughout the world. So you can see that EU 28 is well positioned. For sure, we are recovering from 2 years ago, and currently the market is doing well, comparable also to the US, and I think you mentioned that earlier. China is still positive. Brazil, which I would say had some issues lately due to macroeconomic conditions, is showing first signs of improvement. So this is a good, I would say, a good news, I would say, for the future. And the CIS, I think, Yevgeny, you mentioned part of it before. In terms of automotive growth, so this is a positive also element. So we have a quite a positive outlook for the future. If you just look at, for example, the automotive sector in Europe, where the EU 28 is increasing, we're talking about 20 million tons, and quite positive profile for the future. This is highlighted also here when we are comparing a different, I would say, segment of the market, whether you're talking about construction, machineries, or automotive. This is showing a positive sign, I would say, for the future. In terms of presence, so obviously we do have presence in all the different segments of the market, whether it is automotive, whether it is construction, energy. You can see here, I mean, as my colleagues were mentioning, we do have an important innovation program, and we try to develop that over all the different segments of the market. Just one example here, this is the largest boat which is under construction, and this is also made out of steel. So this is also ArcelorMittal. Infrastructure, we are as well present in all the different segments. This is our long product activity. Energy as well. So basically you can count on ArcelorMittal whether you have a need for any specific steel product in the different segments. So this is pretty much the presentation of ArcelorMittal.
Okay, thanks very much, Liem. Well, great. Well, now I'd like to start the panel discussion. And why don't we start with the first question. I'd like to get the group's thoughts, whatever you can share, about the type of growth you expect to see from the steel industry over the next 4 quarters. Margriet?
Yeah, this works, doesn't it? Yeah, I think giving a comment on the first question, I'm also a little bit building on what Liem already presented earlier. If we look at this year, we really are seeing growth for steel demand. So I think we really getting out of the doldrums, things are better. You see the global steel demand raising by 3% is the expectation. That has been also published by the World Steel Organization. So that's the global number. China would also be 3%, and other parts of the world would be just a little bit below 3%, but overall it would be around 3%. Now, if we would be looking forward, and you compare the numbers which were published in I think, April this year by World Steel and just very recently, you see that the numbers have been revised a little bit upward for the next 4 quarters or for 2018, but they are in general a little bit lower as for this year. So the expectation would be that global steel demand for 2018 would grow by 1.6%, so versus the 3% of this year. And there you see kind of an interesting differentiating pattern. The expectation would be that China probably would level off compared to this year, that more growth would be expected obviously for ex-China countries, so to speak, where the developing countries might contribute more, with the expectation of 4.9%, whereas developed countries would also grow, but a little bit less, just under 1%. So that's a bit the differentiating pattern. Now, if you look at the EU, for this year, the expectation is that we would grow by 2.5%, and next year it would be about 1.4%. So these are at least the fully and the formally published numbers for the next year. So all in all the signals are a little bit more positive in terms of steel demand going forward for the next quarters.
Yeah, that's great. Yevgeny, anything to add to that?
Yeah, thank you. I can talk about Ukraine. So first of all, 2017 was good in terms of economy recovery. So we have GDP growth 2.3%. Which lifted domestic demand for steel products. So basically right now we sell 24% of our production domestically. 76% is exported. For next year, for us, it's a more function of, again, recovery in GDP. So we expect to have at least the same growth. And second, it's a function of peace. If we see peace in the east, we will be able to produce more. This is, and third function, we restarted steel plant, DMK. So basically, this will add 3 million tons of steel production in Ukraine. So if we produce 21 now, next year will be 24, maybe more. So basically, I think we will reach this number, and overall steel consumption also will be higher. We estimate it to be closer to 5 million tons. And also we are working, we have program right now, and colleagues mentioned R&D activities, so we are pretty active in this field as well. So we are trying to substitute imports, which we have. Ukraine is importing steel, not just exporting. So, and we are trying to do our best to produce similar quality products domestically, so to increase our market share. So I think overall domestic sales will be higher next year. Yeah. So.
Liem, I know you spoke a lot to steel growth in your presentation, but do you have any comments on how the expected growth that we've heard about might impact coal prices for next year?
Thank you. I will not be specific about coal prices because you understand that there are some...
I had to try.
Certain constraints that we have to respect. But the positive outlook on the steel side is certainly needs to be combined with maybe the situation on the coal market. You mentioned in your earlier presentation that we are turning the page to, I would say, coming from the previous 2 years when the market was not very positive. And we do see that as important for the whole supply chain, because there is nothing better than a steel market which is doing well, and also a coal market which is doing well. And this is some of the things that we are seeing now, the fact that new mines are coming up, I would say, for example, in the US, and you touched base on that earlier. Mozambique as well, additional production is coming online. We have some new project as well in Australia. So overall, I think that we are entering into a phase which is pretty much good for the different actors of the industry. Obviously, you have some elements that you have to work and to look at carefully. Infrastructure is one thing, supply chain, maybe some mining disruptions. But what is good is that maybe the pricing should be there to sustain and to make sure that the different coal producers around the world are, I would say, do have, I would say, can survive in this environment.
Yeah, great. Next question I'd like to open up for whoever would like to discuss on this. What do you see as the downside risks for European steel production?
Yeah, the downside risks, well, I think first of all what we would need to conclude on these seemingly positive numbers going forward, that the growth is answering the question, what is driving the growth? And is that a kind of a structural growth or more a cyclical growth? And I think the general consensus is that it would be more driven by cyclical growth rather than structural growth. And I think that is also answering part of that question. That means that we all know that in the world in which we live today, things can flip around and turn around very easily and quickly. So how robust are the expectations going forward? So that is, I think, one point. You were mentioning in your presentation a lot about China and the relevance of China into this. If the numbers published by World Steel are correct, and there would be kind of a deceleration into China from this year into next year, obviously that also may add something to the overall, let's say, vulnerability basket, so to speak. Well, other than that, you have other things, not only for the EU applicable, but everywhere. It's about the geopolitical problems we are facing currently, what's happening in the US on politics. More from a steel-related side, obviously steel as a product. You need to look also in terms of application of steel intensity versus intensity of usage of other materials. We have environmental aspects which play a very important role. So there's many factors who can play a role into this of various natures, at least according to my opinion, which may influence the downside potential of the numbers produced.
Yeah. Yevgeny or Liem, anything to add to that in terms of risks? Certainly the cyclicality, the political risk, what's happening in China. It's really difficult to get your arms around any one of those three. Is there anything else you would add to that?
I agree about infrastructure risks. For example, for us, it's not easy to stop and then restart the steel plant, because you need to restart not just the steel plant, but the whole supply chain. So you need to have more locomotives, you need to have rail cars. And for us, for example, at Metinvest, we have a program. So we will build later this year, next year, more than 1,000 rail cars to support these movements, logistics. We have a program to rebuild locomotives. We are financing these programs, and as a company, and we help Ukrainian railroads. It's a government-owned company to do this. Also, we have very close relations with ports, so where we are trying to, because Ukraine, I have to mention, first time in the history also started to import thermal coal. This year. We didn't see this before, and that's why right now we have to compete with our Metcoal for peer space with thermal coal, and thermal coal is of strategic importance to the country. So basically we see infrastructure bottlenecks, and we are working in this direction right now. And if not, it will be significant risk for future steel production. In US at UCC, at United Coal, so we also see risks for in terms of infrastructure. When market was down, both railroads pulled out locomotives, rail cars, and we saw, especially in the first half of this year, some delays in loading vessels. So I think it's not. So I think it's a common not just in Ukraine, but in US, when industry is so much volatile and it's not easy for example, rail companies to recover when you have years of downsizes, and then all of a sudden you have coal at $300 and you need all of a sudden hundreds and hundreds of rail cars to move this coal to the port. It will take time. So for us, it's a risk. We are watching this risk and trying to cope with them. So.
No, I can only agree to what you just said, Yevgeny, also, Margriet. I mean, logistics is playing a big role, I think, in ensuring that we can service our customer on the steel side. Logistics, so we are seeing that in Australia this year. You just mentioned also in Europe. It's the same thing in the US. I mean, when you are coming from a period where you have deceleration over several years, you do need to have a few quarters of a very good or at least positive margin in order to allow the different actors to reinvest into the business. And this is quite important to make sure that the resources that are needed, I would say, in terms of wagons, in terms of also in the mining sector, to advance the development, the drillings, the new project, etc. So I think if you want to have a healthy supply chain overall, we do need to have some succession of positive quarters, if it's not years, to make sure that we stay, I would say, all on the positive side.
I fully agree with that. We are running a little bit long on time, but because we've got such a great group of talented executives, I'd like to open up for maybe one or two questions from the audience, just in closing. Are there any questions? Okay, if not, any closing thoughts? Oh, was there a question? Yes.
Sorry, yes. Just like to ask the panel if you're in agreement with the forecast for Metcoal next year around $150. Is that something that you would agree with or feel is realistic?
I'll take the lead on this. Just to say that we can form a personal opinion on it, but I would prefer not to comment, so I don't know if...
I mean, we all know that this is also written in the books going forward. It is apparently the forward look. Basis on what we've seen in the recent past happening, I mean, I do not dare to give any judgment call on what price developments will look like, because the market is so tremendously volatile these days, and it can just flip around from one day to the other. So, I don't know.
Yeah, great. We're over time. So I'd like to thank this wonderful group of executives from the steel industry. Thank you guys very much. This was a great discussion.